want to again thank you for being on this call today with Monica Rebella, CPA and President of Rebella Accountancy, which is a CPA firm that specializes in accounting, tax, and consulting services for hundreds of dentists in California. The topic of the call today is Pathways to Retirement, 3 Practice Transition Strategies and Timing. If you're not a current client of Rebella Accountancy or you have not met her, Monica Rebella is a CPA and has 26 years of accounting and tax expertise, which includes 13 years working with the Big 4, Big 8 firms and over 13 years experience working with dental practices. She is past president of the Orange County, Long Beach chapter of the California Society of CPAs and is a member of the AICPA. She has conducted training sessions for accounting firms, as well as lectured on tax and business matters to the California Society of CPAs, UCLA Dental School, and the Orange County Dental Academy. She runs her own firm in Tustin, California, providing accounting, tax, and consulting services for over 300 businesses throughout California, specializing in dental offices and small businesses. Monica, welcome to the call.
Well, thank you, Jeff, and thank you to everyone that's on the call this evening to take time out of your evening and to listen, but I so appreciate it. We've got a particular topic tonight, which is Pathways to Retirement, 3 Practice Transition Strategies and Timing. The purpose of this webinar is that I've got a lot of doctors that are talking to me about, I think I'm on that 5 to maybe 7 years before I'm out, and some even less than that. And it's always a conversation that we have about, well, what's that going to look like? And, you know, are we really prepared not only for what that strategy might be, is there a strategy? What things we want to talk about making that 5 to 7 years really work? And are you really there mentally as well as financially? So there's so many things around retirement. But I'm going to touch on tonight the 3 main strategies that seem to happen for dentists when they're looking at going towards retirement. And then we're going to talk a little bit about, you know, financially, are you there? How do you determine if you're financially there? I'm not going to go in depth with it. I've got another seminar that I've done about really being prepared financially. What does that look like? How do you calculate it? But we're going to kind of blend it. I'm a CPA. I can't get away from numbers. It's just in me, so I'm going to have to do that. But let's go to our first slide. So our first slide is the good and bads of the 3 strategies, right? So here are the 3 strategies. Selling and walking away, okay, number 1 strategy, and often that is the strategy for a GP practice, okay? Bringing in an associate to buy you out, another option, and retirement, partial to full retirement. Our last thing we're going to talk about is how to determine your exit point. So that is going to be something we'll chat about as well. So let's move on to our next one. Our number 1 strategy is selling and walking away. So we want to sell, want to get done, we want to be done. How are you going to do that? Many dentists work through a broker. There are more dentists now that are working through a banker, specifically Citibank and Bob Affleck. So if you don't know him, Bob is building up. Not only does he talk about buyers and help buyers, you know, talks to buyers, helps buyers figure out what they could afford and also whether they could qualify for a practice they're looking at. But now that they know that they've got different buyers that are coming to him for these kind of things, sellers are realizing that he may have a buyer for them. A CPA, I specialize in dental practices. I do have associates that are looking to buy as well as doctors looking to sell, and other. You know, you may have just the dental society might know. So there's other ways you could find it. So multiple options of how you try and find that buyer for yourself. So, you know, what is important to you when you're looking at that buyer? And I've run through different scenarios here because different things come up, right? So some doctors are really concerned about the buying dentist having the same philosophy, the same dental clinical philosophy that they do, that they are going to diagnose and treat their patients in the same manner. I've had some doctors just say, I'm selling and walking away, and whatever they do with the practice, that's up to them. I really, at this point, I'm not going to put anything on who could the potential buyer be. So it really runs a gamut. But for the most part, I would say many sellers seem to want to have a good fit, that their patients are going to have a good fit, a similar fit with the buying dentist, but not always. So do you think, and is it important to you that the buyer keep on key staff? Is that something that is going to be a key item for you? I got to tell you, if it is, I will tell you the buyer has been coached and will be coached by brokers and others to not change things for 6 months, maybe longer. The dentist is gone. You got a new dentist. You don't want to shake things up and have a new hygienist, a new RDA. You don't want to have a new front person. Those patients want to feel that the key components outside of the dentist are still there. It's still the relationships you've had with others that's going to keep them there and help the transition. So for the most part, they are told you really shouldn't change too many things too quickly or too fast because you want your patients to still feel comfortable. Now, in saying that, when you have a dental consultant go in and the buyer has this dental consultant take a look at the practice, there may be some people that just aren't going to work out, and they may not stay. But you have to find out whether it's important to you that they keep the staff, but like I said, for the most part, they do for a little while. Is it important to you, if you own the building, that you sell the building to the buyer? I don't have this come up too often because a lot of dentists don't own their dental building, but where they do, I encourage the seller, my clients, not to sell the building. That's a revenue source for you. That's an income stream for you in retirement. I don't like to see you guys sell the building because we know that that dentist is going to pay rent, and that's going to be an income to you in retirement. So typically, I don't like to see the selling dentist buy the building. Usually the buyers don't have enough credit to buy the practice as well as the building. But in saying that, it does come up from time to time. So it's a matter of, have you thought about that? Do you have a firm stance? There are some brokers that push selling both, and there's reasons. A lot of brokers will get their broker fee on selling real estate as well as the 10% that they get on selling your practice with no additional work, right? They just tell the buyer, you should buy the building too. So be aware of trying to have a combination sale going on there. It may be in your best interest or it may not. You need to flesh that out. So let's go on to our next slide. So a lot of people say, well, what do you think I could get from my practice? A lot of people want to know that. And there's different ways of doing it, and it really varies by geography. Okay, it really varies by geography. It also depends on fee-for-service or insurance and what insurance you take, PPO versus HMO. Not too many take HMO, which is a good thing, but some do. It has to do with whether you have associates running the practice or if the dentist is still actively involved in the practice. And again, geography makes a big difference on the price of the practice. Just to tell you, Northern California in many places is 50% of 3 years average gross. And that's very different than LA and Orange County where we have a higher percentage. But again, it still does affect where you are geographically. So why is it important that you know what percentage of the sales price would be associated with particular items? And we call this the allocation of the sales price. So you've set the price. You've got a buyer. The buyer's agreed to the price. You're running down that road, and we've got to say, oh, what is it we're selling? We got to figure that out. You need your CPA involved in this. You absolutely have to have your CPA involved in this. There's 5 things that are sold, 5 things that are purchased: goodwill, furniture and equipment, patient lists, covenant not to compete, and supplies. That's it. Those are the 5 items that are sold and purchased. What happens is the seller wants as much of the price to be goodwill because that is going to get long-term capital gains rates. And long-term capital gains rates are great tax rates, fabulous tax rates. The buyer wants to have as much of the price as equipment because they get a write-off quicker than the goodwill. The goodwill goes over 15 years, the same with covenant not to compete and patient lists. But the equipment can be all written off very quickly, the first year or over 5 years. And the reason that's important is that helps you in the 5 to 10 year period that you're paying the loan back. You want to be able to have deductions that mimic the cash going out to pay the loan. It helps you. You're getting a tax deduction when you don't have the cash. It's to mimic that process. So it's so important why you get a CPA involved and is looking at the tax issues as well as this. So what time of year is best for you to sell? Well, I guess it's when you get a buyer. But if I had my druthers and if someone was asking me, it would be January 1. The reason I would say January 1 is multiple. One is if you do it at the very beginning of the year, you don't have any other income from the practice than the sale. That's all you have. So we don't have to worry about the profit from the practice for tax purposes as well as the sale of the practice. So for me, it's a pure, we just don't want to have too much tax loaded on you. The other is sometimes we want to have a retirement plan and have you be able to shelter some of that sales price from tax by putting it in a retirement plan. Well, if it's the beginning of the next year, you won't have any employees other than yourself, and so it's 100% your money, okay? So that's really attractive to do that. So I would say the beginning of the year if I had my druthers, but sometimes it's when you get a buyer, and that's when it is. But if you can time it, that's the best time. As early a part of the year as possible. January 1 if possible. I talked to a lot of doctors about, will you want to continue to work? And a lot of doctors think they're going to. Well, I'll stay on. I'll help them. I'll help the production. Well, doctors, if you were a one-doctor practice and someone's buying your practice, it doesn't become a two-doctor practice unless you are going to be the associate and the doctor buying it is not going to work in the practice. And in that case, they're going to have a big problem. You stay and you're working on patients, and when you finally go, who is going to be the dentist? It'll be confusing to the staff. Who really owns this practice if you're still there? So you got to realize if you've sold it, it was a one-doctor practice, there's no money in it for the buyer if you stay and work. They have to work it so they can pay you the loan that they have taken to pay you. So it really depends. If you've got a practice where you have an associate in it plus yourself, yeah, you could work back a bit, but how long? I have heard some doctors tell me, for several years, 2 or 3 years. And the reality is once you've retired, it changes. And you'll find out you really value your time off more than you value going in there. So sometimes it's a matter of, yeah, I can do it for a while, but, we want to take a 3-week vacation. Or we're going to go and do this next week. We need to have 4 days weekend. So it really comes down to once you get into that mode of retirement, it's not so much fun to go work anymore. You're happy with your time. Let's go to our next slide. Our next slide is, will you take 100% of the immediate amount or take a note? So there are two options when you sell a practice. You can have the buyer go get a loan from the bank, or you can say, gee, what's the interest rate I could charge? That might be better than if I got paid out what I would go and do with that money and make on the money in investing it. So sometimes there is a reason why the selling doctor would want to take a note. Now, in saying that, I don't encourage it. It's not the market practice. It's not what's happening now. There was a time in the 90s where dentists were taking notes. And the reason is the banks were not lending like they are now. We've got Bank of America, Citibank, First Citizens Bank. We've got banks that are throwing money at the buying dentist. There is no need for the seller to take a note. Taking the note back is very risky. If the buyer decides to stop paying you, what are you going to do? Go and tell them you need the payment? Get an attorney, have to take them to court? That's expensive. That's really expensive, and still they may not pay. Just because you get a judgment doesn't mean they pay. What is your collateral? The equipment? Are you really going to go in there and take the chairs? I mean, there's not much value in the chairs. Could you take the practice back? Yes. That is one of the options on a note, is you could take the practice back. But again, you got to go to court, get an attorney. It's very expensive. It's not the norm. It's not the way things are. It's best to let the buyer go get a loan and just getting paid out because it just makes more sense. Tax-wise, tax rates keep going up. You could end up paying more tax down the road than what you would if you sold and you paid a lot of capital gains now. If you take it in a note, there's a lot that you have to take in the first year and get taxed, and then it's a matter of the tax rates in the future. So you could pay more. So we talked about the retirement plan. When you sell, we want to see if we can shelter it in a retirement plan where it's 100% your money because you no longer have employees. That's one of our top strategies. Management fee. So I have seen some arrangements, specifically in these specialty practices, where they are really going to mentor who's coming on, that part of the practice is structured as a management fee to be paid over a couple of years because there is mentoring. So we take a part of the sales price and we say, we're going to make this income over the next couple of years. And one of the purposes is funding that retirement plan. So if it becomes income to selling dentist, now we have money to put in the retirement plan for a couple of years. And some retirement plans require that you have it for a couple of years. For the seller, it's income that could be sheltered. For the buyer, this is 100% expense for them. So there are times where this makes sense and it's a win-win on both sides. So there can be a way to structure the deal, which is a little unusual from the normal. Our next slide is bringing up a whole new strategy. So we got through the sell and walk away. Those are kind of the issues with the sell and walk away. You're done. What kind of considerations? What do we have to do with looking at the taxes? And how you might want to structure a little bit different about the payoff. Now we're going to talk about bringing in an associate. So I hear a lot of doctors saying this. It's like, I'm 3 to 5 years out. I think I should just get an associate. If they're a good person, then I can sell to them. So I want to bring them on with this concept that if it works out, they're the one. They're going to be able to buy it. It's great. This is good for a specialty practice, endo practice, an oral surgeon practice, a perio practice, any practice where it's referral-based. You really need to bring an associate on first because your referral base needs to get comfortable with that person. The buyer needs to feel that they're going to continue to be able to have that stream of income, and you want them to be successful, doctor. You want them to be successful. So we want to make sure that that buying dentist is in there, that the referral base is now really is seeing their work. Their work is being done by the associate. The associate's bringing in their own referral base. They need time to bring their referral base on. So it's a great opportunity for a specialty practice because face it, if you're an endodontist, an orthodontist, a periodontist, if you're referral-based, there's not much to sell if you cannot guarantee that the referrals are going to keep coming. There's nothing to sell if you can't make it very comfortable that the referrals are going to keep coming. And the way that happens is good introductions, but also enough time for the associate to build that up themselves. So it's important. The downside of saying, I'll bring an associate in because I'm on a 3 to 5 year path, and if it works out that they're going to buy, it's a carrot. It's a carrot, doctors. And there are associates out there that just don't want to wait for the selling doctor to say when it is they're going to get around to sell. And what happens is the date keeps getting pushed out. And so that associate who might want to buy your practice and is working hard gets frustrated and finally goes on to something else or goes on to buy a practice because it keeps getting pushed out. It keeps getting pushed out. So it's the right associate at the right time. You have to be very close to getting done to bring that associate in so they know the timeline is in the near future. And you have to be clear on that time frame. You can't be wishy-washy. You really need to know what that time frame is. In a lot of GP practices, associates just don't work out to be the buyer. That happens all the time. It's very common that that associate just is not the buyer. There's a lot to tackle when you own a business, as you know, doctors. There's a lot of hats you wear. It's not the clinical. It's the managing the staff. It's managing the whole process. It's making sure production goals are kept. It's keeping your patients happy, the whole staff keeping them happy. There's a lot more to it, and some associates just can never get to that point. Some associates can't sell. They don't want to go get referrals. It's just not in them to do it. I had a client where in 7 years, an associate never brought any work to the business. And it was said that, you would be a partner, but we both have to grow this practice. We can't stay at this level. And in 7 years, just couldn't be done. not even by accident. You're a dentist, maybe I should come to you. No, never told anybody what he did, never wanted to bring it in. That's a problem. You got to be careful about that. Okay, let's go to our next slide. Partnership. So this is our third strategy that is considered when we're looking at retirement and what the options are, what this might look like. Partnership. So when we think of partnership, if you're married, your spouse is your partner. So you have to think about it in business as well. This is someone that has like thoughts for the business, is as motivated in building the business as you are. This person has to be an entrepreneurial spirit as you are. If not, then you need to be completely opposites. Partnerships that seem to work are those where one wants to manage the business and the other one is great at clinical and bringing in business. So I don't see them working often. In fact, I have only one partnership in a dental practice still remaining after many partnerships that I had with doctors that had their practices as partnerships. I have one that still exists because it was two. I'll take that back. I've got two because it was meant to be a buy-in situation. So it was the right associate at the right time to buy in, get to 50%, give the selling doctor a few more years to work, build up their retirement plan, build up getting to that, what they're going to do in retirement, build their whole scenario about what am I going to do in retirement. Those are the two left. Every other dental practice that was a partnership has completely dissolved in the 10 years I've had this practice. So they are not long-term in the dental field to have a partner. Have you worked together yet? Do you know what it's really going to be like to work together? And it's very different if you were an associate at a doctor's practice versus have you come together to work in a business together. Does the staff know the other doctor? How do you think that personality is going to go with the staff? So if you already had a practice and you're going to bring a partner on, you're probably going to continue the management role, and that could be okay. But again, you have to have a motivated individual to build the business. They have to also want to build the business and be excited about it, because if not, they're not a partner. They're just an associate dentist. You have to have someone that's going to either relieve you from management burden or help build the business to be a partner. So I want to make sure that you look at it in that way. You have to have similar philosophies of running the practice or let one handle the management of it. But even in saying that, it comes a point where there's disagreements. So if you're thinking, I'll bring a partner on or I want to go into partnership with this other person, there's a lot, and there's books very easy book to read that I would recommend before you go down that road. The worst possible is to do it with a friend. The best way to make an enemy is to go in business with a friend, and it's absolutely the truth. There are so many things that come up that it just destroys a friendship that you have, so you have to be careful about it. Okay, the next thing about partnerships, the role in the office. We've talked about that. Is someone going to manage, and the other one is going to do clinical and help build the business. If you have the partnership and you've got an associate there or you're going to bring on a partner, you need to set the buy-in up front. You need to set the price up front. You need to figure out what the time frame is up front. So if we're bringing a partner on, the percentage buy-in and the price absolutely is, you're going to bring a partner in, so you have to figure that out. The time frame is important if it's an associate that's moving up to the partner. How long is it going to be? Not only that is that if it's going to be a 50% buy-in, but it's going to be over the next 5 years, 10% a year, that's the percentage. So you have to figure that out, what percentage you're going to buy in and from what time frame will that happen. Will the person ultimately buy 100%? The reason I bring this up is sometimes it's a big practice and it's a two-doctor practice, and the doctor buying in gets to 50% and realizes that's all they can produce, that's all they can really manage. They can't manage 100% business of the business with bringing an associate on, that it really needs to be an owner and not manage another employee or an associate. So you need to find out and chat through the process, will this person ultimately buy the other 50% or have 100% ownership? If that person is not going to buy the other 50%, are you going to reserve the right to find another buyer for the remaining 50%, or are you going to allow the associate who's buying in as the partner, find the other buyer for the 50%? So definitely you want to think through some of these things before you get there. So those are the three strategies. We talked about selling and walking away. We talked about bringing on an associate, and we talked about the partnership. So those are really the three main paths to the transition process and how to do your exit. You know, those are the paths that we really see when someone's looking to retire. And it comes down to, do you want to be 100% out, or are you still phasing yourself out, right? Or do you get to the point where I'm completely done, I'm going to sell it all, or are you thinking, I just want to cut back and not work as hard, but I can't see not doing this, but I want to cut back some. So those are really the strategies and the reason that you have those other strategies. So our next slide, as I mentioned to you, is how to determine your exit point. How do you kind of figure out, yep, this is time? Did you have a particularly bad day and you're thinking really hard that I just so want to be done and retire? I just don't think I have it in me anymore. So how do you know if you can retire? So you've had that bad day. You've been working for 30 years. How do you know if that's the bad day that can allow you to make one of these decisions? So let's talk about that a little bit. My next slide. Are you debt-free? And when I said debt-free, I mean, yes, your house also. So is there no debt in the practice? And when I say debt, bank loans, credit cards, are you on a cash basis with everybody? Where's the mortgage on the house stand? Because when you're getting ready for retirement, you don't want debt. You need to be on a cash basis. You're not going to make any more money. You are now made all your money. So you don't have more money coming in to pay past debt. You need to be working with, this is what I've got. This is the cash I'm going to have. And that needs to take over and make sure that you can live with that. So our next point is, do you have a retirement plan with more than $300,000 in it? I find many of my clients have $300,000, maybe a bit more. Now, there are exceptions. There are definitely exceptions. I've got some that are getting close to that 3-year time frame, maybe 4, that have done quite well and have got a good retirement plan. But do you know if it's enough? If you know if it's enough. Do you know how much you have in your other investment accounts? Is selling your practice your retirement plan? Is that your entire retirement plan? I had a client that sold his practice. That was his retirement plan. That was in 2009, and we all know what happened with the stock market. It wasn't a good retirement plan to have the sale of the practice be it. It just did not help him. He went back trying to look for an associate job, which took him 2 years, maybe even longer. Had to sell some rental real estate that he had. So selling your practice should not be your entire retirement plan. It can't be. It just can't be what you have. So you've got to think beyond that and make sure you get some good consultation on this. So our next slide is, okay, I can't help myself. Remember, I'm a CPA here. I'm going to expand your thoughts. So we talked about what it might look like, what kind of strategies for it. But what is retirement planning? Really, what does it include? And it includes the current analysis of your situation. What do you have in all your accounts? Retirement account, your investment accounts, your real estate, your practice. Current situation. Are you 3 years out, 5 years out? What do you think your time out is? And how much money do you have? Do you know what's going to come home from the practice? Your practice is paying your car. Your practice is paying travel, perhaps. Your practice is paying your meals and entertainment. Your practice is paying some other stuff, and your salary. So do you know your health insurance being paid in there? Perhaps in your disability is going through your distribution account but being paid by corporate money, business money. Do you know how much more expenses are coming home to the home budget? It's so important that we put that together. Target your retirement age. I've got some doctors thinking they're 5 years out, but when we put the numbers together, it's not 5 years, it's 10 years. It could be even longer than 10 years. And the biggest driver of the reason that it gets extended out is debt. Debt will continue to take out your retirement age to longer periods of time. So you've got to keep paying down your debt. You know, if you think you're getting close, if those bad days are adding up, you got to get towards that debt being paid off and understand your budget at home. So your age, when you're going to do it, your current debt situation, college funding. I've got some doctors that are getting so tired. Their back hurts. They're worn out. Mentally, they get worn out. But they got kids in college still. I can tell you, you're probably not ready to retire if your kids are still in college. You know the cost of college these days. There isn't a university around outside of the Cal State system or the University of California system where you're not paying $45,000 for tuition. And when you add in cost of board and stuff, it's $60,000 a year. It's expensive for college education. Not something you can pay if you've retired. You need money still coming in to replace what you're going out, right? When you're retired, there's no more money coming in. It's all going out. So we got to think about that. And then the status of your retirement funding. You know, do you have to ratchet it up? Do you have to plan to put more into it so that you can retire in a time frame that makes sense? You know, more things to consider on retirement planning, our next slides. We talked about it, your savings in your investment account, your lifestyle. A lot of people want to keep their lifestyle in retirement, and that's absolutely fine. You just have to know, will you be able to, based upon what you have and what your debt is and what you're going to be able to but able to have in retirement as far as cash flow. So lifestyle is an issue. And as we get older, our lifestyle changes. You know, it may not be exactly the same. You may not be traveling as much. You know, things do change, so you have to think of that. Where will you live? I have people that tell me, well, we'll just downsize. So we'll take equity out of the house and we'll downsize. I think that's a great plan. A lot of people don't want a two-story home as they age because it becomes a little uncomfortable going up and down with our knees and other things. So downsizing is great. The kids are gone. They're grown. They have kids of their own. You don't need a big place. Here's what I say about that. You have to buy down, right? So there's people that say, well, we'll downsize. You might, but it may be in square footage only. It didn't in cost. And to actually downsize, the price has to go down. You have to have equity that you take out. So it comes down to geographically where you're going to live. It may not be different even if you go to a single story because the prices are equal, depending on where it is. So estate planning. Do you have your trust and will? If you don't now, regardless of retirement planning, you should have your trust and your will. You need to have it, especially if you had kids. You absolutely have to do it. If you have a business, you have to do it. You've got to make sure those things are protected for your family. Long-term care and other insurance, definite considerations on how you're going to handle your long-term care. For most people that retire, will they have enough money for their health care is their number one concern. Will we have enough money for health care? Number one concern. So it is something that you've got to think about. It's not only, okay, we could live on this amount per year and that's going to take us out. What about the unexpected expenses for health care? What about any other unexpected expenses? So definitely things to think about. So for our next slide, funding. Yeah, I told you, I can't help myself. I'm a CPA. We're going to get into some numbers here, but just a little bit. So focus on how do you know how much is needed? What I'm going to say, this is not when you're 3 years or 5 years out from retirement. it is a career-long process of making sure you've put enough away, or saving it, put stuff in a retirement plan, so that is little by little, not in a hurry. Starting early is so important, starting early. So our next slide is determining your net worth. Okay, the reason I'm bringing up your net worth is really about where your liabilities are and really what you have in your accounts. So this is called a statement of net worth. You put down the value of everything you've got on the left of cash, savings, checking, your investment accounts, your stocks and bonds, your 401k, your retirement accounts, and yes, it would be your business. So other would be your dental practice. Okay, we put in there your home, rental properties, we put in your car, we put everything in there. It's really coming to what do you have and how much is it worth? On the right side, it's all the debt, including your mortgage. And when you take everything that you own and the value minus the debt, that gives you your net worth. Okay, that gives you your net worth, right? So cash minus expenses, that gives you how much cash you have left. It's kind of the same concept. Here's everything I own. If I liquidated it and paid off the liabilities, what am I left with in cash? That's the concept of net worth. So you want to start with that because we need to know what you have in all the accounts and where the debt stands, right? It's important. Our next slide, estimating your income needs at retirement. So I went through this last year with really getting into the numbers. And that webinar, by the way, is recorded. You can go back to it. But I'm going to take you through it real quickly. So here's the deal. When we have calculations we can do on this, we go through how many years till you want to retire. So we picked 10 on this as an example. And we said that we think that the growth rate on the retirement funds will be 5%. We think the inflation will be 2% per year. It's important to know how your investment monies are going to increase per year and what that's going to do to your expenses, right? Your expenses go up 2%. That eats it, and you have a real rate of return of 3, right? So number of years in retirement. So if you retire in 10 years and you've got 20, we're looking at someone that retires at 65 and will live to 85. You know, this is the concept of this one. The growth rate of investments during retirement, 4%. So before retirement, we did 5. We're doing inflation at 3 in retirement. Now we got an effective rate here of 1%. It's not a lot of growth. You're in retirement. You're not looking to put it in the stock market, right? So, and you got a tax rate of 35%. Now, I'd say the 35% estimated tax rate in retirement is probably high, but I'm looking at someone that's going to continue their lifestyle. We've got living expenses here and your annual needs of $150,000 a year. So that's what the lifestyle is, $150,000 a year. And we're using 80% of that because typically what you need to retire is 80% of where you are now. So right now the 150 is it, and we're thinking 80% in retirement. So that's where we are with that. So we're thinking 120, and then we put the rate of 35% at tax rate, so it comes up with, okay, if that's the tax rate and you need 120, then you really need to have income of 184. That's really where it needs to be because your 120 is cash that you need. So let's go to the next slide. So now we're putting in sources of income. So Social Security, and presuming that it'll continue for a while, we've got that in there. So we've figured out what your annual Social Security is going to be. The next level down is estimating, again, we took the 184, that's what you need to have because taxes have to get added back to what you're going to do. We put in your Social Security that you're going to take, so now we're coming up with where the money's going to be. So we take the 184, we do the Social Security, so your target here now is at 213. So we're a little bit higher because we've now put in the Social Security. We put in income from your investments at 17%, and we factored in all these other calculations in there with 20 years that you'll be in retirement. Again, we've got a 1% real rate of return between the expected rate of return plus the inflation. So we've come up with what you need based upon the dollars, targeted dollars that you want per year is $3,009,000. That's what you need to have that lifestyle, $3,009,000. with these parameters. Now, we can always play with them. There's a lot of built-in calculations here, right? So is the tax rate right? Did we get the Social Security right? Did we really understand what you need, what your household needs are, and what your personal needs are, what the vacation cost is, all the expenses coming from the office? Did we get that right? Maybe we didn't get that right. So there's a lot of ways to play with this a little bit. Our next slide, now we're throwing in the sale of the practice in here. So I hadn't figured it at this point. Now we're figuring in the sale of the practice towards how much money you need to have based on those parameters to live. So I threw in here a $1 million practice, right? We think that you're going to be able to sell your practice for $1 million. We looked at what the total assets are in the retirement accounts. We've got 650, okay? That's what we anticipate is going to be in your retirement account and selling the practice at $1 million, okay? We took the $1 million of selling it, but we took it as a percentage of collections. Probably not the best estimate and need to refine this, but for purposes of the example, you can say we went from $1 million to $785. So we've got some money from the retirement account. We got some money from the sale of the practice. Remember, we're trying to get to 3.9. Our next slide, we're looking at how much money that you're saving. We're looking at, we are basically at 3.9 that you need to have. And kind of going through these calculations of where the shortfall is to tell you where you are. So you can see that we've got just a huge amount of shortfall here. We've got $2.2 million that we're short. We got 700 and some for the practice, 650 that we've got in the retirement account. It leaves a big void that you have to fill. And you can see based on this calculation, it's almost $180,000 a year that you need to do in the next 10 years for retirement to make the dollar goal based on these assumptions. You can see it's huge. It's not insurmountable. If you have a good practice, the amount that you can put in your retirement account can be near that number a year. On a GP practice, it's a stretch. Sometimes we can get there, but again, it depends on the practice. If you don't have a top-producing practice, it'll be very hard to meet this. Again, remember, this is a lifelong and career-long process. Start early, but first is to figure out where you are. So there's a few more slides that I'm actually just, not going to do it. They're in here for your amusement that you can take a look at it because the numbers change based upon a selling price, based upon changing the rate of return. There's a lot of changes in the assumptions that we can make. So here's where we are. So we're in one of the last slides at the end. Let's start with what you know today. Where are you now? So that net worth, right? What do you have? What's it worth? What's the values? Where are you with debt? So let's figure out where you are now, and then the variables. When do you want to retire? What does your lifestyle look like? Where are you today? Are you really within a 5-year or 10-year period? Do we really know some of these? So it's where are we and what are these things that we still have to work on? And that's important. We need to do that. I want you to retire when you want to retire, and you do as well. There's some other things in here with the rate of return, how we figure out what that percentage is and how it's fluctuated from time to time. And again, kind of in there for your enjoyment. So I will point out that in my last slides here is that I would be happy to give you a free 1/2 hour second opinion on your strategy or just a second opinion on where you think you are. For my clients, it's something we should be talking about, and obviously, you're already there with me to get that half an hour to talk or whatever strategy we need to put together. Sometimes that puts some calculations together, and there may be an additional fee to do that. Just depends on how many different scenarios we want to go through, how complicated it would be. But I encourage you, it sneaks up on us. You want to be prepared. Really, when we start our careers, we should be thinking about our end game. When are we going to retire, and what's that going to look like? It's from the beginning. It shouldn't be when we get to the end. And I know we get distracted along the way, but our end game is to be successful and retire successful, and it's something we need to start. But at the very least, let's assess it now. So that's the end of my slides. Jeff, do we have anybody that has on the line with questions?
I'm going to open up the lines, Monica, and if you are listening live on the call tonight, just go ahead and state your question. We have also several people on the webcast. If you're listening on the webcast, in the bottom left-hand corner, you can click on the Submit a Question there in that box and send your question, and I'll check on that real quick. I don't see any questions, Monica. Again, if you're listening on the phones, you can ask Monica your question. Or if you're listening on the replay, maybe, Monica, what's the best way for them to get a hold of you if they're not listening tonight and they either want to call or email you?
Absolutely. So if you would like to call, the phone number here at the office is 714-619-0667, 714-619-0667. If you would like to send me an email, my email address is M-R-E, B as in boy, E-L-L-A, so it's mrebella at Rebella, R-E-B-E-L-L-A, CPA.com, mrebella at RebellaCPA.com.
Monica, I'm making one more quick check. I don't have any questions coming through. Again, I think you cover a ton of information. That's probably why. So we'll thank everybody for being on the call tonight. Again, you were with Monica Rebella, CPA, President of Rebella Accountancy. Tonight's call was Pathways to Retirement, 3 Practice Transition Strategies and Their Timing. And again, if you want to talk to Monica, if you're a client or you're not a client, again, she offers the free half-hour second opinion strategy meeting. Just contact her via the phone 714-619-0667 or mrebella at RebellaCPA.com. Monica, thanks again for taking the time out of your schedule to do this, and we'll talk to everybody soon.
Well, thanks so much, Jeff, for your time. Have a nice evening. Bye-bye.
Bye-bye.